Welcome back. We now have from the Credit Suisse Investor Summit someone who is well known for his mastery over Indian financial institutions, not just in Credit Suisse but across the country. We have with us Ashish Gupta, Managing Director at Credit Suisse. Thank you very much for joining us, Ashish. Well, actually, it's the financial sector and banks that are actually brimming with news, developments and market action. So let me start first with this very important circular that the Reserve Bank brought out on February 12th, almost hastening the recognition of NPAs and their resolution. What are your first reactions to this circular itself in terms of impact?
Thank you for the introduction. It was very kind. I think you actually yourself summarized it that the circular actually accelerates the process of NPA recognition. We have now known for some time that the impaired assets of Indian banks are much higher than the reported NPA numbers. As per our estimates, the impaired assets are closer to 16% of loans compared to the last reported NPA numbers, which are closer to 10% of loans. And this incremental 4 to 5% of loans, most of which is actually sitting either in the restructured bucket or STR or S4A, post this recent circular of RBI will get recognized as NPA more quickly. A large amount of it actually might precipitate on bank balance sheet as early as next couple of quarters.
Okay, but 10 to 16% is a large increase. NPAs can rise by 60%, you think?
See, all of it won't immediately move to NPA, and also RBI has still provided a window for banks to work on resolution plans of these assets. Additionally, another important consideration we have to keep in mind is the first list of RBI, the first 12 cases, their 270-day period ends around April. And you should expect to see resolution of those assets, and hopefully those assets or the large share of those assets which are 3 to 4% of loans for some of the banks will start moving out of the NPA bucket, right? So there will be inflow from this 5% of loans and there will be some outflow on account of some of the earlier NCLT cases getting resolved.
Okay. Well, how would you describe this circular itself? Unavoidable, admirable, last of the bad news?
So, I think it is much needed, right? Because as a regulator, RBI was clearly feeling the pressure that now with over 4 years or 5 years where some of these forbearances had been in place, it had not helped the resolution process. And given whatever feedback one is receiving from the first stage of NCLT cases, the resolution process has been much better. The same banks, if you see the various steel cases as well, they've been willing to take haircuts varying between 30% to as high as 70-75%. So I think the regulator clearly felt that the decision making under the IBC code was superior to some of the decision making that was happening in the JLF forums. And this is perhaps the reason it decided to accelerate and move forward with this circular.
Fine, fair enough. Let me come to more pleasant topics. We've had a lot of small finance banks getting listed. One of them is, IPO underway and will get listed. Is that a space you would look for buys at all?
Again, without naming specific banks, what I would like to highlight is that Since now nearly 3 years since RBI started granting a couple of new bank licenses and some of the small bank licenses, we have seen 6 companies converting to banks. They have been microfinance companies, infrastructure lenders, some NBFCs converting to banks. And actually the success of all these has been a mixed bag. Some of these guys have very successfully transformed into a bank by broad-basing both the asset as well as the liability side of the balance sheet. Some of them have not been as successful both on the loan book side as well as broad-basing the funding profile. I think within this lot, if we ignore the valuations for the moment, investors should look for banks that have been able to build a good deposit franchise as a bank, and secondly, on the loan side, those that have been able to get into higher yield loan segments.
NBFCs, now that rates have risen, yields have risen at least, is there anything in that space you like, anything which can take advantage of that big report you wrote of FinTech? You know, how many of them look like good candidates for a FinTech revolution?
Sure. Again, without naming names, I would kind of highlight 2 broad structural trends that are still favoring NBFCs. One is that loan demand in India is picking up, and clearly the aggregate banking sector is not in a financial position to be able to cater to all this loan demand. So there will be enough demand of credit for NBFCs to be able to grow at a good pace. Historically though, whenever we have had rising rates, NBFCs as a stock have not done well. But there is a large difference now. Banks have moved to an MCLR regime, and what that means is that bank lending rates start moving up even as incremental deposit rates start moving up, right? And if you see some of the largest banks, just in the past month, they have raised MCLR by 20 basis points, and that provides NBFCs with much better pricing power so early in the cycle compared to historically. So I think this time around the pressure on NBFC margins may not be as sharp as earlier cycles.
Well, it's so far so good then. Thank you very much, Ashish Gupta, for joining us, and have a good conference out there.